New data shows inflation slowed down more than expected in October, but inflation remains high, rising almost 8% in just 1 year.
Many wonder what the economy will look like in 2023, less than just 2 months away.
This morning, we're joined live by Mississippi State Associate Finance Professor Dr. Brian Blank.
Good morning, Dr. Blank. Thank you so much for joining us. Appreciate it. So now,
Happy to be here.
What are some of the encouraging and discouraging parts to the new data around inflation?
As you mentioned, inflation was slower than expected this month, which is encouraging. This is the lowest reading in over a year on the core measure of inflation, which is a little bit less volatile. This most recent reading would be equivalent to about a 3.5% annual rate, which would be much slower than what we've observed over the past year. And this is largely because we're finally seeing prices of services and health insurance, groceries, apparel, home appliances, used cars. All of these prices are beginning to fall. And while we knew some of this was coming, I know that consumers will be happy to see that food prices rose at the slowest rate that they have all year after seeing them rise so quickly recently. Much of what we saw in October is also expected to continue in November and December, as some of these core goods are also going to keep declining. So that's also good news. Unfortunately, as you mentioned, inflation's still really high. 7.5% would be much higher than anything we would have seen in a pre-pandemic era. So this is definitely not something to celebrate. Even over the last 3 months, the annualized rate's been about 6%, which is still really high as well. So overall, while it is coming down, it's still higher than we would like.
I will say, since you've said it's the slowest that groceries prices have risen, that kind of gets me excited about Thanksgiving. Maybe we will get that feast after all. But yeah, like you said, it is still high. But what does this new inflation data possibly indicate about, the size and the number of future interest rate hikes?
Well, I think the chair of the Federal Reserve, Jay Powell, when he saw this report, was likely thinking two things. One, which we mentioned before, slower inflation is good. But the second one he's probably still thinking is high inflation is still not the goal. Mm-hmm. So more rate hikes are likely still on the horizon over the next few months. Currently, we're expecting about a 0.5 percentage point increase next month, which is the slowest since this spring, but it's still a very large rate increase. Mm-hmm. And this would bring the federal funds rate up above 4% for the first time since before the financial crisis. This is also not expected to be the last interest rate hike. The Federal Reserve is likely to hike a few more times moving into next year until we see some more progress on inflation. So we can expect the federal funds rate to increase above 5% by the summer.
Okay. Well, one of the big words going around right now is recession. I'm still learning about how all this works myself. Can you tell us about some of the driving factors that may officially push the U.S. into a recession, and do you think it'll happen?
You're right. Most economists and forecasters are anticipating a recession, and this isn't new. This has been the case for months. Some even thought that we might have entered a recession 6 months or even a year ago. I'm a little more optimistic. While I think inflation is going to remain higher for longer than some anticipate, and this will keep interest rates higher than expected, I do think that the labor market will continue to remain strong next year, just like it has this year. Mm-hmm. The economy has grown very slowly this year relative to last year, but it is still growing. But the most important thing for most people is that they still have jobs. And job prospects for most Americans are quite good right now. Wages are still growing. So for the economy to dip into recession, the labor market, it would have to slow down a lot. And I don't think that's going to happen quite as quickly as most people are expecting. Even with the big headlines that we're seeing around layoffs, most of these are relatively small portions of firms and jobs overall. And other parts of companies are still growing.
Well, that is some good news for 2023. But overall, what is the economic outlook for, the U.S. housing market, gas prices? You have mentioned job market, but also, consumer confidence.
Yeah, I think the housing market's going to continue to slow down towards a more normal level next year. Energy prices will probably continue to be impacted by the land war in Europe, not only just this winter, but for much of the next decade, as Russian oil and natural gas are going to have to be replaced. Fortunately for us, this is going to impact the rest of the world a little bit more than it'll impact us. Mm-hmm. In terms of consumer confidence, I think it's worth focusing less on what consumers say and more on what they do. So consumer spending will be something that I'm watching. And at this point, it's been really strong, and that's expected to continue as well. I do anticipate that the declining size of the labor force resulting from demographic and immigration trends will continue to drive a lot of the labor market trends that we've been talking about. Two things that have been true for the last several months. Most experts and economists have been forecasting a downturn that has not materialized as expected, and inflation has been higher and more persistent than forecasters anticipate. While forecasting another year, just like the one we had, seems like a losing proposition after the last 3 years, I'm expecting 2023 to look a lot more like 2022 than most people did.
For those just now joining us, we are talking with the Associate Finance Professor, Dr. Brian Blake with Mississippi State University's College of Business. Thank you for your time, sir.
Thank you.